Welcome back to the Capital Exchange. I'm Steve Wilbur. Today we're going to discuss prediction markets and whether they provide useful information or they're just simply speculation that is more sophisticated. Prediction markets allow people to buy and sell contracts based on future events such as interest rate decisions, election results, inflation reports, corporate earnings, or even sporting events. If a contract trades at 70 cents, the market is generally assigning that outcome to be about a 70% probability, but that isn't a fact or a guarantee. You need to know it reflects a group of people willing to put money together behind their predictions, and even well-funded options can be wrong. Prediction markets have also attracted regulatory scrutiny. The state of New York recently sued Kalshi, arguing that certain event contracts amount to illegal gambling under the state law. Kalshi maintains that its contracts are federally regulated under financial products with the Commodities Futures Trading Commission. The courts will address this legal issue, but the dispute raises a broader one. Where does investing end and then gambling begin? So it'll be interesting to see how that plays out for a lot of these other prediction market companies. My primary concern is the mindset that these markets can create. I think it creates somewhat of a false sense of hope. When people see an 85% probability, they may treat the outcome as nearly a certainty. But an 85% probability still leaves a 15% chance that you could be wrong. We've seen this before. We've seen it before because inflation was expected to be temporary, right? And markets have repeatedly anticipated Federal Reserve cuts, and they didn't occur as expected. Consensus can be useful, but it also can be wrong. Prediction markets can also fuel herd behavior. As more people favor one outcome, its implied probability rises. So if the media reports a higher number, attracting more attention to that situation, and potentially more participants start betting in that direction, or I shouldn't say betting, actually going that direction, the prediction then becomes a part of the narrative in that market. And so that probability of 85 or 75 or 70% I mentioned earlier increases, and it makes people feel more comfortable going into that prediction. At Allen Capital Group, though, we don't do that. We build portfolios around predicting the next headline. No one consistently can forecast the market. We don't have a crystal ball. No one does. Not an economist, not Wall Street strategists, or even prediction markets. Instead, we build portfolios designed for a range of outcomes, whether interest rates rise, fall, or just remain unchanged. Your financial plan shouldn't depend on one prediction being correct. It should be grounded in diversification, risk management, and your long-term goals. Successful investing isn't about predicting the future perfectly. It's about having a disciplined plan that can withstand the unexpected. I want to thank you for joining the Capital Exchange. If you found today's episode helpful, please subscribe, leave a review, or share it with someone interested in the prediction markets. Thank you for listening. I look forward to it next week.